Hi, everybody. The second basic thing that I want you to understand and remember when going into the final exam, I know all of you know this equation: assets equals liabilities plus owner's equity. I know all of you know it, but I suspect, and I actually know that some of you do not understand why is this the be all end all of this course. Why is this so important? Where does this come from? Why do we have this equation? Um, I know you guys understand that debits need to equal credits, the balance sheet needs to match, all that. That's why we have it. But what's the meaning? Where does it come from? The big question is, where does it come from? And you really need to understand that. But if you understand that question, then a lot of the journal entries, a lot of the things can come very easy from that understanding. So let's look at a very, very simple business. To see what we can understand, how we can get this understanding. So say a 15-year-old a 15-year-old starts a business. The only thing in the business is $100. That's it. There's nothing else in the business except $100 bill. Okay? $50, 50 of dollars of that came from his mother, and he needs to return. All right? Very, very, very simple. Okay? So, based on that, we know our equation: assets equals liabilities plus owner's equity. What's our definition of assets? We know that assets is anything of value within the business. Here, the only thing of value is that $100 bill, right? There's literally only this $100 bill that is an asset for this 15-year-old. All right. And now, what is liability? Liabilities, the true definition of liabilities within your textbook, you've got that liabilities are the debts of a person or a business. So the debt here for this 15-year-old is that $50 bill, right? That he owes to his mother. Owner's equity is the real definition. This is where a lot of you are lacking this understanding. All the asset, the entire value of the assets that is not owed to somebody else is belongs to the owner. Again, the entire value of the company, everything the company has of value, take away everything that the company owes from that value, whatever the company owes to other people or businesses, is left over for the owner. And in this case, that is that $50 bill. Right? But things can get a little more, slightly more complicated. So say you have all right. So say you have, let's take another example. Um, let's take this 15-year-old again. 15-year-old starts a business. The only thing in the business right now is a laptop, which cost him $400. Okay, and 200 of that came from his mother, and he needs to return it. So very simple example. It's the same thing again. I want you to see that it's not, even though you can't split the laptop, right? So say we've got this laptop. I'm going to try to draw here. Okay. Here's a laptop that this kid has. And now this laptop, we can really split it up if and say it belongs, part of it is owned by the mother, and part of it belongs to the owner of the business, which is the 15-year-old. Everything in the business, everything of value within the business belongs to either the owner or somebody else. That's what this equation means. Because what we're doing in accounting is keeping track of everything that has value that goes in and out of the business. I'll say that again. It's very simple language. In accounting, all we're doing is keeping track of every single thing that has value that's going in and out of the business. So we take everything of value, and we need to know whether that thing of value belongs to us as the business or it belongs to someone else. And based on that, we come up with this equation of assets equals liabilities plus owner's equity. So when you think of journal entries, a journal entry, many things could be happening in a journal entry. You may have, in a journal entry, you may have one asset going up and another asset coming down, or you may have one liability going up and another liability coming down. You may have an asset increasing and a liability increasing, an asset decreasing, a liability decreasing, an asset increasing and owner's equity increasing, an asset decreasing, owner's equity decreasing, and it can get more complicated. You can have an asset increasing, a liability increasing, and an owner's equity account increasing, all in the same transaction. There are infinite number, when it comes to accounts, there are infinite number of things that can happen.